Hello, everyone. Felipe here. Happy Monday. Hope everyone's doing great and having an awesome start of the week. So, as you know, I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. So, I'll go ahead and jump right into it. I'm sure you guys kind of heard of the ongoing debt ceiling negotiations that's been going on between in terms of basically raising the debt ceiling. And it seems to be an ongoing issue that both sides of the party are kind of going back and forth, and no decision hasn't been made yet. But I decided to kind of look into, hey, what happened the last time these negotiations got this intense, to get an idea if that does occur again, what might potentially be expected, right? So the last time these debt ceiling negotiations this intense was way back in 2011, and that was basically when literally before the deadline, 72 hours before, is when finally an agreement was made to increase the debt ceiling. But yet, even though it was agreed to, since they took so long to push the debt ceiling upward, S&P credit rating agency downgraded the U.S. Debt, right, from AAA to AA, which a credit downgrade is never a good thing, especially for a country. Which a credit downgrade basically means that the debt that is issued is deemed to be riskier. Therefore, the borrower has to pay higher interest rates in exchange for issuing the debt to the borrower for money, right? So it basically means that the downgrade in credit rating the US received in 2011 then cost the United States more money in interest they had to pay to borrow when they issue US securities, right? Such as treasuries and so forth. So, and then that subsequently led to a big market sell-off, even though they did agree to 72 hours prior to the deadline. But it seems that currently uh, the issue is very similar to before. So here I found this article interesting because it kind of goes into the past, right? 2011 issues. Or well, in this case, speaking of now in comparison. So as of late January, the US has already hit its debt ceiling, or the amount it is able to borrow. And the Treasury Department is employing what is known as extraordinary measures to cover the country's bills. Should the US default, that would have a disastrous economic fallout, including higher interest rates, millions of job losses, and a major hit to the country's GDP. Very unlikely, because this never happened before. This would be like a very rare black swan event with potential catastrophic results. So in 2011, Republicans unwillingness to back down on spending cuts almost led to the U.S. to intentionally go over the brink for the first time, a near miss that contributed to the country's credit rating getting downgraded by Standard and Poor's. Back then, the market plummeted and the country's borrowing costs went up by 1.3 billion. So that's kind of like what I was saying. If any debt gets a downgrade, it basically increases the interest rates that have to be paid on that debt to issue that debt, right? Because it becomes riskier with a so-called downgrade. So um here just basically goes into at the time Obama learned the lesson, don't negotiate, and Vice President Biden at the time was right in the middle of those negotiations. An economist involved in the 2011 talks on behalf of the White House, and he has no eagerness to jump back in them because he saw what they were like, saw them that nothing good came out of it. So in 2011, the US came within 72 hours of actually defaulting on his debt, only narrowly averting it. So they did raise the debt limit back then, but I guess since they took so long, the US received a downgrade on credit, and the market still sold off pretty viciously after that because of the delay, right? So by the time the bill was passed, however, some of the economic damage was already done because the US was so close to default. The stock market had already dipped, and the cost of borrowing had increased for the government as well. Higher borrowing costs effectively means the government has to pay more for loans and has fewer resources to spend on public investments like infrastructure. So that was back then in 2011 when they received a downgrade by the credit rating agency S&P. The outcome in 2011 revealed that even getting close to a default was dangerous and had a problematic impact on the economy, experts say. So basically, it's speculation. What can potentially occur if something as catastrophic as that were to occur. But even the fact that in 2011, they didn't increase the debt ceiling until 72 hours prior to the deadline, and then it still caused issues. So on another article, basically, the US may maybe just days away from being able to pay its bills, but Wall Street has seen this movie before, and the market seems unbothered for now, which basically the market has been, in a way, going upward even throughout the debt ceiling battle and regional bank crisis and so forth. It's kind of in my opinion, in cognitive dissonance. It's not correlating with kind of what's going on, but then that's kind of how it always seems to work anyways. So the market's basically complacent because this is nothing new, right? This has been an ongoing issue every time these debt ceilings battles occur, right? But this seems to be one of the ones where basically a decision or at least finding common ground towards a decision has been seemingly more of an issue. So this is speculation, basically. At the very least, there would be a huge sell-off on Wall Street. In its latest analysis, UBS says the S&P could fall by 20% in the case that the debt ceiling is not raised. I would speculate it would be a lot worse than that, but that is just someone's opinion. Analysis believe the sell-off could match or surpass a precipitous drop in September 2008 when the House of Representatives rejected a $700 billion rescue package as the U.S. was on the precipice of a global financial crisis. So that was when the whole Lehman Brothers issue was going on, and Treasury and the Fed basically was attempting to bail out everyone. And at that point, that was blocked and caused a sell-off. So they're comparing it to something that could potentially be something like that. So the default will weaken the US dollar. Again, unlikely scenario because it's never happened before, but that would be some sort of black swan, right? Why would the US dollar weaken? Because US treasuries are basically, or US debt is basically IOU in exchange for dollar, right? And paid in interest. So it is basically the US dollar, right? Analysis also believe credit rated agencies would downgrade the country's credit rating. That would be the most likely worst case scenario, I would say, which again will still be very bad and would cause some sort of issues, such as it did in 2011. So currently the US, the United States of America, has a AAA rating from two of the three major credit rating agencies. The US suffered a downgrade in 2011 from the other major rating company when S&P Global Ratings lowered the country's rating to AA plus amidst another round of debt negotiations under President Obama. At the time, bond markets determined all kinds of borrowing costs, which would go sharply higher if there were a US default. Mortgage rates, for example, would climb even higher, as would interest rates on credit cards. It would be catastrophic if that occurred, but it just seems very unlikely. Shosima Shah, Senior Global Investment Strategist at Principal Global Investment. This guy goes on to say, echoes what policy makers have said, that a government default would not only kickstart a domestic recession, but also potentially another global financial crisis. I mean, we saw a recession last year, and potentially we are in one this year. I don't know why they keep saying, oh, it's the coming recession that never comes. It's, you know, they're always talking about a recession as if it's something that is coming in the future. I would definitely agree with the global financial crisis situation if that were to occur. And then on another note, some stuff that I've been looking into. Sometimes a lot of these articles are very misleading, so I like to dig in. So for not misleading, but over dramatic, right? So Home Depot reports biggest quarterly sales miss in over 20 years. And then this goes into this over here where I got to quickly switch my screen. And so basically Home Depot recent earning report wasn't great. So here it's kind of what the CEO said. Our sales for the quarter were below our expectations, primarily driven by lumber deflation and unfavorable weather, particularly in our Western division, as extreme weather in California disproportionately impacted our results. So I've been talking about lumber prices for a while and how they had basically crashed, and lumber prices tend to kind of correlate with the housing market. So when they go down, it signals that home builders are purchasing less bulk lumber in bulk to build more and so forth. And in this case, you could see that it's affecting Home Depot as well in terms of their sales and revenue. So I was curious because of kind of the dramatic articles that has been pushed out there saying, you know, worst report in 20 years. They did not have a great quarter. However, it wasn't horrific, but it does signal that they might potentially be earning less in the future, as per what the CEO of Home Depot is saying. So here, net earnings are down about 8.5% from the previous year, which is a decent amount, not something great. But it could also mean that things are kind of stabilizing from the craziness of overvaluations of things that were occurring in 2021 and so forth. So this is basically Home Depot's balance sheet. Things that I've noticed is they've had a pretty decent reduction in cash and cash equivalents, basically money held or things that are very easily liquidated to turn into cash pretty quickly. That has gone down quite a bit. I would say a little over a 50% decline in cash and cash equivalents. assets are nothing dramatic there. Total assets, nothing dramatic there. And basically the other only thing that stands out is net earnings, net income, which has gone down by 8.5% as per this quarterly result, which is not a great thing. And then you have the CEO basically stating or saying that he sees things slowing down in the future due to how bad lumber prices have been performing, and other things such as people renovating their homes less, and less home renovations occurring and so forth. So yeah, what I was kind of going on about lumber prices, which I've been talking about this for quite a little while. Here we have a lumber futures, which is basically the lumber market. Here you kind of saw the craziness after the COVID lockdown, where lumber prices hit all-time highs, came crashing down, went back to over all-time highs. And then you can kind of see the big crash in lumber prices, which some might say it's back to normal price ranges, but yet it is currently causing the issues with the decline in sales in Home Depot and other similar companies that sell these commodities, right? And then another thing that this signals to me is that home builders are purchasing less lumber, so potentially there's less home building going on, which is something to keep an eye out for. But I've been kind of talking about lumber prices for a bit now, and then I haven't checked this in a while, but I'm curious to see housing prices have been kind of like bouncing back up quite a bit since they're just continuous drop from August 2022. So month over month housing prices have bounced up instead of just consistently going downward. But I'm curious if that is sustainable and it would continue to bounce up, right? This is basically Robert Shiller's home price index, month over month changes in home prices. The other time that has had like a very nasty drop like that prior was the whole 2008 fiasco, and then it had a nice bounce before another big drop. I don't know if that's going to happen again, but home prices seem to have bounced from the August of 2022, a continuous drop, which there's some sort of bounce there, right? So it hasn't been just steady decline in housing prices. They've recovered quite a bit, which is a good thing for housing prices, to say that they're released. So cool. That's some couple of things I've been basically seeing in terms of what's going on in the market. So let me see over here. So yeah, I mean, if you guys like that, like what I've basically like what I said and would like to hear more, please like and subscribe. I would appreciate that. And thank you guys for your time. I will see you guys soon, and have an awesome week.